There are 111 million Americans who cannot pay their credit card bill in full each month. 111 million people carry a balance, pay interest, and watch the number grow. And of those, more than 27 million can only afford the minimum payment, the number the bank calculated specifically to keep you in debt for as long as mathematically possible. This is not a story about financial irresponsibility. This is a story about a system that was designed, tested, and optimized over decades to produce exactly this outcome. Because credit card companies do not make money when you pay your bill in full. They make money when you do not. And everything about how they structure the product, the rewards, the minimum payment, the interest rate, the annual fee, the points that expire, the categories that rotate, are built around the gap between what you think you're getting and what they're actually extracting. Let's start with the interest rate because the number is so large it should be scandalous and somehow isn't. The average credit card interest rate in the United States right now sits above 20% annually. 20%. At a time when the Federal Reserve's benchmark rate has moved up and down through economic cycles, credit card rates have moved in one direction only: up. Banks doubled their profit margins on credit cards over the last 2 decades. When rates went up, credit card APRs went up. When rates came back down, credit card APRs stayed up. The spread between what banks borrow money for and what they charge you to use it has never been wider. That spread is the business. To understand how deliberately this was constructed, you need to understand what happened in the 1970s and the 1980s. For most of American history, states had usury laws, limits on the interest rates lenders could charge. In 1978, the Supreme Court ruled in a case called Marquette National Bank versus First of Omaha Service Corporation that a bank could charge the interest rate allowed by its home state to customers anywhere in the country. Within a few years, banks began relocating their credit card operations to states with no usury caps, Delaware and South Dakota primarily, specifically to escape interest rate limits. The legal architecture that allowed 29% APR credit cards to exist in every American wallet was not an accident of the market. It was a deliberate regulatory arbitrage executed by the banking industry in the years before most current cardholders were born. The system was rigged at the foundation, and everything built on top of it reflects that. Now let's talk about the minimum payment, because this is the mechanism that makes everything else work. When you carry a $5,000 balance at 20% interest and pay only the minimum each month, typically 1 to 2% of the balance, you will spend approximately 17 years paying off that debt and hand the bank roughly $6,000 in interest on top of the original $5,000 you borrowed. You will pay more in interest than you borrowed on a single credit card over 17 years. The bank calculated that minimum payment number. They knew the math before you signed the application. They built a product where the minimum viable payment produces the maximum possible revenue for them over the longest possible timeline. Some credit card agreements in the early 2000s were setting minimum payments so low, sometimes 2% of the balance, that cardholders with typical spending habits would never actually pay down the principal at all. They would make the minimum payment every month and end each year owing more than they started, because interest was accruing faster than principal was being reduced. The Credit Card Act of 2009 required banks to disclose how long it would take to pay off a balance making only minimum payments, and to include an alternative figure showing the monthly payment needed to pay it off in 3 years. The law required disclosure because the math, once visible, is so damaging to the bank's narrative that they would never have shown it voluntarily. Here is where the architecture gets more sophisticated. The rewards program. Rewards points are the most elegant customer retention mechanism in the history of consumer finance. They feel like the bank giving you something. They are the bank taking something. Here is how. When you use a credit card to buy anything, the merchant pays an interchange fee, typically between 1.5 and 3.5% of the transaction, to the payment network and the bank. This fee is baked into the price of every product you buy, whether you pay with cash, debit, or credit. Cash customers subsidize credit card rewards programs with every transaction. But the rewards program does something more important than generate revenue. It creates a psychological attachment to spending. Every dollar you put on the card is a dollar that earns points. Points feel like savings. The feeling of earning while spending suppresses the instinct to spend less. Banks have studied this. Cardholders who use rewards cards spend more than cardholders who use non-rewards cards. The rewards program is not a benefit added on top of the product. It is a behavioral modification tool built into the core of the product. And then there is the devaluation. Airline miles that used to get you a domestic flight for 25,000 points now require 40,000 or 50,000. Hotel points that covered a free night 5 years ago cover fewer nights today in fewer properties with more blackout dates. Points expire. Programs change their terms with minimal notice. The value stored in your rewards account is not a liability the bank is required to honor at a fixed rate. It is a number they control, can move, and in some cases have simply eliminated when they closed a program or merged two systems. You cannot sue them for devaluing your points. You agreed to those terms when you signed up, in the language of the cardholder agreement that runs to dozens of pages and changes at the bank's discretion with 45 days' notice. Now look at what has happened to annual fees, because the trend line is one of the more brazen things in recent consumer finance. Annual fees on premium credit cards have been climbing at a rate that has no relationship to inflation or the cost of providing services. Chase's Sapphire Reserve card increased its annual fee by nearly $250 in a single year. American Express Platinum went up by $200. The justification in both cases was new: perks, credits for Uber Eats, StubHub, Saks Fifth Avenue, Equinox gym memberships. Perks carefully selected to be specific enough that many cardholders won't use them, broad enough that the bank can claim the fee is justified. The effective annual fee, what you actually pay after using every credit available to you, is much lower than the stated fee, but only if you remember to enroll, track the categories, use the right vendors, and redeem in the right windows. The credits are structured as cognitive labor transferred to you. If you do all the work perfectly, you break even. If you forget or find the credits don't match your lifestyle, and the bank has data on how often that happens, you pay the full fee for a fraction of the value. There is a number that makes all of this concrete. Americans paid $2.1 trillion in credit card interest between 2010 and 2026. That is more than the entire outstanding student loan debt in the United States. It is a transfer of wealth from cardholders to banks on a scale that has few parallels in modern economic history, and it happened quietly, one minimum payment at a time, behind the language of rewards, cashback, points, and the carefully designed fiction that the bank is offering you a deal. The most important thing to understand about credit card companies is that their best customer and their most profitable customer are not the same person. Their best customer, from a marketing perspective, is someone who pays on time, uses the card frequently, and earns rewards. Their most profitable customer is someone who carries a balance, pays the minimum, and stays in debt for years. Those two customers often start as the same person. The product is designed to facilitate the transition. The next time you see a credit card advertisement, the points, the miles, the cashback, the sign-up bonus, the 0% intro APR, read it the way you would read any other financial contract, not as a list of benefits, but as a description of the trap. The sign-up bonus exists because the bank has calculated that the revenue from your future interest payments and interchange fees will exceed the cost of that bonus within the first year. The 0% intro period ends. The rate that follows is usually the highest rate on the card. They know the math. They built the math. The question is whether you do too. That is what this channel is for. Not outrage, Just the numbers, plainly spoken, so you can see the structure clearly for the first time. Because once you see it, you can't hand them your card the same way again.